The S&P 500 up a microscopic 0.12%. The Nasdaq Composite slipped 0.05%, and the Dow Jones Industrial Average scratched out a 0.28% gain.
Barely a blip.
Right. The closing bell rang just 15 minutes ago on this Tuesday, March 10th session, and the scoreboard we're looking at is, honestly, it's an absolute masterclass in deception.
Yeah.
I mean, if you just glance at those closing prints, you might assume absolutely nothing happened today. But we have our hands on the institutional-grade trading notes and the market internals right from the close, and they paint a radically different picture. We're going to decode the exact footprint the smart money left behind during this choppy mess.
Yeah, the surface tape was practically engineered to put retail traders to sleep today, but the undercurrents are incredibly aggressive. We are looking at a market effectively trapped in a macroeconomic vice grip right now.
Totally.
On the downside, you have this floor that was just established by former President Trump's rhetoric, his quote-unquote very soon de-escalation comments regarding the Middle East.
Which injected a baseline of geopolitical relief into the open.
Exactly. But pressing down from above is this incredibly heavy ceiling of sticky inflation fears. It's a classic wait-and-see tape ahead of tomorrow's critical February CPI data.
At 8:30 a.m. sharp.
Right. And that is the catalyst that breaks the vice grip.
Have you ever looked at a flat stock market and just assumed nothing was happening? Because today is the perfect example of why you can't do that.
Right.
Let's look at how capital actually positioned itself into the close. The Dow, gaining 0.28%, looks completely unremarkable until you look at the intraday journey.
It was wild.
We opened down 246 points on those early Iranian retaliation fears.
Yeah.
And then we quietly, systematically ground higher all session to finish up 244 points.
Yeah.
That's a nearly 500-point intraday swing hiding inside a 0.25% gain.
It is a textbook outside day phenomenon. And what it reveals is a massive institutional rotation. When the Dow, which is the ultimate proxy for blue chip, defensive value, when it absorbs a heavy morning gap down and then completely reverses to close near the highs, you are watching a direct flight to safety.
They're bracing for impact.
Precisely. Capital isn't leaving the market entirely. It is actively seeking out the sturdiest ships it can find in the storm.
But the real risk here is the stark underperformance in growth. Because if they're just rotating into blue chip safety, why did technology end up as the day's biggest laggard? Down 0.8%.
Well,
The notes attribute this to a slight backup in the 10-year Treasury yield, but is it just the yield curve applying gravity, or are we looking at structural exhaustion in the tech trade?
it's a combination of both, really. You can't ignore the sensitivity of these high multiple software names to the long end of the curve right now. Any backup in the 10-year instantly forces a recalculation of forward earnings multiples.
The algorithms just hit the bid on tech.
Yeah, exactly. The yield backup was simply the excuse the algorithms needed. But there is a broader exhaustion at play, too. When you have a market holding its breath for inflation data, nobody wants to be caught over-leveraged in the highest beta sector of the market.
Let's talk about that intraday price action on the broader index, because the fade was brutal today.
It really was.
We hit an intraday high on the S&P of positive 0.7% by mid-morning. It looked like a legitimate breakout attempt. But by the closing print, the institutions had actively faded that entire move, compressing the gains to near zero.
They clearly used the morning liquidity to distribute.
Yeah.
The big money was not buying the dip today. They were systematically selling the rip.
Selling the rip.
Whenever you see a morning geopolitical relief bounce completely dismantled by the afternoon, it tells you that institutions view any upward momentum purely as an exit door.
And the MOC data, the market on close data, confirms exactly that. We saw significant institutional sell-side imbalances, specifically targeting energy, XLE, and financials, XLF. But think about the context there. If Trump's de-escalation rhetoric provided the relief rally, why would institutions use the MOC to actively dump energy and financials? Shouldn't a stable Middle East benefit the broader economic outlook?
In a vacuum, yes, but we are not in a vacuum. We are in a rigid risk management window ahead of CPI. Geopolitical relief is temporary, but inflation data dictates Federal Reserve policy, and that is permanent. Institutions looked at the bid underneath energy and financials this morning, recognized it as artificial liquidity, and they sold into that strength to trim their overall portfolio beta. They are raising cash, plain and simple.
Which brings us to the volume confirmation, or rather, the lack thereof. Tuesday saw 20.2 billion shares traded across the exchanges. That is right on the 20-day moving average of 19.99 billion. But you have to juxtapose that against Monday's tape. The notes described Monday as an explosive 22.41 billion share washout.
Yeah, Monday was pure capitulation. Heavy hands were forced to act. Tuesday was a digestion day. The market absorbed a massive shock to the system on Monday, and today the conviction completely evaporated.
So printing average volume on an inside day right before a major macro catalyst.
It confirms that the real money is sitting on its hands. No asset manager in their right mind is going to commit fresh heavy capital at 3:45 p.m. on a Tuesday when the CPI could invalidate their entire thesis at 8:30 a.m. on Wednesday.
I want to pivot to the market internals, because this is where the facade of a green S&P 500 completely falls apart. The headline index finished positive, but the advanced decline ratio closed at a dismal 0.38.
Ouch.
We are talking about 11,181 stocks advancing versus 3,100 declining. The index printed green, but the underlying tape was absolutely bleeding out.
Yeah.
How long can a handful of megacaps physically carry this market?
Not long at all. I mean, the severe divergence is the definition of a fragile tape.
Yeah.
When you have an AD ratio of 0.38 on a green index day, it means capital is terrified. It's concentrating into the narrowest possible leadership.
The notes explicitly highlight the rush into quote-unquote fortress balance sheets, names like Marvell and Palantir.
Right. And these aren't just tech plays right now. They're being treated as sovereign bonds. Investors are hiding in companies with impenetrable cash positions because they do not trust the broader economy.
And the carnage in that broader economy is glaring. Small caps, tracked by the Russell 2000, closed with an AD ratio of 0.22.
It's a total suffocation of the secondary names. The average stock out there is effectively in a bear market right now, completely disconnected from the S&P 500's headline resilience.
It's the ultimate leading indicator of a trap.
It is. The institutional notes summarize this dynamic with a pretty brutal analogy, actually. They said, when the index rises on fewer and fewer soldiers, the generals eventually get shot.
Wow.
Yeah. The S&P is currently fighting to reclaim the 6,800 level, yet underneath the surface, less than 40% of all stocks are trading above their 50-day moving average.
And that creates a massive bearish divergence on momentum indicators. We're seeing the relative strength index, the RSI, making lower highs, while the actual price of the index attempts to grind out higher lows.
Exactly. It's pure exhaustion behavior.
Oh, yeah.
You can engineer an index higher by squeezing a few trillion-dollar market cap names, but you cannot fake breadth.
Right.
If the 6,800 reclaim attempt fails here, and those mega-cap generals finally catch a downgrade or an algorithmic sell program,
There's zero underlying support to catch the index.
none. The notes explicitly flag the 6,730 support level as the immediate trapdoor. And if that gives way, you are staring straight down at the 200-day moving average.
Let's look at how this exhaustion is playing out in individual equities, because the earnings reactions are equally telling. Look at Hewlett-Packard Enterprise, HPE. The notes highlighted this as a primary example of the earnings trap.
Oh, absolutely.
HPE delivers a beat-and-raise quarter. The fundamentals are solid. The forward guidance is upgraded. It opens green, but immediately reverses and closes down 0.8%. If an AI-adjacent hardware name delivers a flawless quarter and still gets faded into the red, are we hitting a terminal wall on the AI premium?
We're hitting a wall of expectations. The AI hardware trade has been priced for absolute pristine perfection for the last 18 months. A standard beat and raise is no longer the catalyst for a 10% gap up. It is the liquidity event institutions use to exit their positions.
All the news.
Classic sell the news environment. When a market is this top-heavy and capital is this defensive, good news simply isn't good enough to justify adding risk. They take their profits and rotate into those fortress balance sheets we just discussed.
But I want to push back on the idea that capital is purely terrified, though. If we look at the volatility complex, the VIX, the standard fear gauge, spiked to an intraday peak of 27.30 during the worst of the Iran escalation last week.
Right.
But by Tuesday's closing print, the VIX had crushed all the way down to the 21 to 22 range. A VIX at 21 implies a substantial amount of premium just evaporated from the options market. Doesn't that volatility crush suggest that panic hedging is actually over?
You have to distinguish between panic and risk. The acute systemic panic over a catastrophic Middle East escalation. Yes, that was priced out. That is why the VIX dropped from 27 to 21. But a VIX sitting at 21 is still elevated. It's not a structural all-clear signal. Furthermore, if you look at the VVIX, the volatility of the VIX itself, it is hovering below 130.
Meaning the options market isn't actively pricing in a sudden explosive tail risk event at this exact second.
Correct. It is a transition from panic hedging to cautious waiting. The crush in the VIX was a tactical bounce, a mechanical unwinding of short-dated put options that expired worthless once the weekend headlines cooled off.
Ah, I see.
But do not mistake a lack of immediate panic for bullish conviction. The underlying bid for protection is still incredibly firm ahead of the CPI print.
And that bid for protection is centered entirely around the 6,800 level on the S&P. The institutional notes repeatedly refer to this specific strike as the gamma wall, or a massive put wall. Let's break down the mechanics of this, because 6,800 isn't just a psychological line in the sand. It is a structural barrier built by derivatives dealers.
It's the fulcrum of the entire market right now. A put wall at 6,800 means institutional options dealers have accumulated massive short put exposure right at that strike. Due to the mechanics of delta hedging, as the S&P approaches 6,800 from above, those dealers are mathematically forced to buy the underlying index futures to neutralize their books.
Which creates a mechanical floor.
Exactly. It is an artificial, bouncy shield that repels the price action back upward.
So as long as that dealer positioning holds, any dip to 6,800 gets immediately bought by algorithmic hedging, which theoretically gives the bulls the momentum needed to push back toward the 6,900 resistance.
Yes, but the sword cuts both ways. And this is why the notes are stressing risk management. If a catalyst, say, a red-hot CPI print on Wednesday morning, creates enough organic selling pressure to slice cleanly through that 6,800 put wall, the options math inverts violently.
The gamma flip.
Gamma flip. Once you break below that critical strike, dealers go from long gamma to short gamma. Instead of buying the dip to hedge, they are suddenly forced to short the index aggressively into the weakness just to protect their own books.
Which just accelerates the sell-off.
It's effectively a trapdoor opening. The mechanical selling would likely send the market into a free fall straight down to the next major liquidity node at 6,700.
That makes Wednesday's open incredibly binary. 6,800 is the ultimate pivot point. So what is the actionable playbook? With the heavy chop, the breadth divergences, and a massive macro catalyst looming, what day two plays are the institutional desks actually setting up for tomorrow?
The desks are relying on historical probabilities to navigate the chop here. The notes point out a very specific sequence. Monday was a massive washout and a bullish key reversal. Tuesday was an inside day, a neutral pause. Statistically, when you have a major reversal followed immediately by an inside day, there is a 62% probability that the original upward momentum continues on day 3.
A 62% probability of continuation gives you a real statistical edge, assuming the CPI doesn't completely blow out the models.
Right.
And the institutional notes have isolated 2 specific equities to watch for that day 2 continuation, starting with the heaviest hitter on the board, NVIDIA, ticker NVDA.
NVIDIA's chart is incredibly compelling right now. The stock has been wandering in the wilderness a bit, but it recently pulled all the way back to test its 200-day moving average. For context, this is a secular support level that NVIDIA has not broken below since late 2024.
And on Monday's washout, it didn't just test that 200-day line. It printed a flawless, bullish engulfing candle right off the support.
Which is the ultimate technical signal of institutional defense. They defended the secular trend line. Now, the setup for Wednesday is entirely about day 2 confirmation. If NVIDIA can hold Tuesday's higher lows despite the tech sector weakness we saw today, algorithmic momentum traders will be looking to ignite a tactical squeeze.
And if it catches a bid, it acts as the primary engine to drag the S&P back toward that 6,900 resistance zone.
Exactly.
The second setup is entirely removed from the semiconductor space. The focus shifts to the future of energy theme with Constellation Energy.
Ticker SEG. Constellation is acting as a pure play beneficiary of the current macro environment. Energy has been volatile due to the Middle East, but CE has completely decoupled from the crude oil chop. It recently experienced a sharp, healthy pullback and spent Tuesday forming a very tight bull flag consolidation pattern just above its 50-day exponential moving average.
The standout detail in the notes regarding Constellation is the volume profile. They highlight high relative volume during this consolidation phase.
And that is your footprint. High relative volume on a tight consolidation means quiet, aggressive institutional accumulation. The smart money is absorbing all the available supply at these levels. The trade setup is clear. If CE breaks above Tuesday's high, it triggers a technical breakout with a measured target of the $210 resistance level.
So, synthesizing all of this data from the closing print, the institutional mandate is aggressively defensive but highly opportunistic.
Yeah.
The playbook is do not blindly chase the headline index. You ignore the green screens on the S&P until the advanced decline ratio crosses back above 1.0, proving that the foot soldiers are actually participating in the rally.
Yeah.
You anchor your entire risk profile to the 6,800 level. If the put wall holds, you play the tactical breakouts in names like NVDA and CIG. If 6,800 breaks, you respect the gamma flick, dump the beta, and go to cash.
That is the exact translation of the order flow. The smart money is hiding in fortresses, defending strict technical levels, and refusing to commit broad capital until the macroeconomic picture clears up.
You know, looking at how this entire ecosystem operates around that 6,800 level, it leaves you with a deeply systemic question. We just outlined how institutional dealers have constructed a massive algorithmic put wall at 6,800. We know that if the price hits that line, automated hedging will mechanically buy the market, and if it breaks, automated hedging will ruthlessly short the market.
The tail is wagging the dog.
Exactly. It forces you to wonder, are human fundamentals actually driving asset prices anymore, or have the derivatives entirely swallowed the underlying stock market? If trillions of dollars are just ping-ponging between gamma levels, dictated purely by options math and dealer hedging, are we really analyzing corporate value, or are we just trying to front-run the algorithms?
It is the defining structural question of modern market microstructure. When the options flow becomes larger than the underlying equity volume, you are no longer trading the company. You are trading the derivative of the company.
And that is exactly why you have to look under the hood. You cannot survive in this tape just by reading the headline numbers. Keep your eyes on the internals, watch the volume confirmation, and respect the closing print. We will see you back here for the next deep dive.